Good morning. I'm pleased to be here to speak to you about Esperanza Resources. We're a precious metals development stage company advancing the Cerro Humil gold project in Mexico. The project boasts over 1.5 million ounces, and we're advancing it towards production. The company itself has a market cap of $110 million, backstopped by $50 million in cash and securities. We're well funded to advance the project. The last 12 months have been a particularly active time for the company. In September 2011, we announced a preliminary economic assessment that outlined average gold production of over 100,000 ounces a year at low operating costs of around $500 per ounce. With the PEA in hand, our chairman, Bill Pincus, as a large shareholder, really wanted to accelerate the project to production. With production in mind, he brought in an executive and mine operating team that became available through the Mine Finder's sale to Pan American in January of this year for $1.5 billion. So the Mine Finder's operating team has come in to really fast-track Cerro Humil towards production. Concurrent with the management addition, there was a private placement done in May that secures the equity component of funding for Cerro Humil. It was originally announced at $10 million, but upsized to $34 million on the back of overwhelming demand and positive feedback. With the new team in place, we announced a substantial update to our resource in September 2012, which increased measured and indicated gold resources by over 60%. We also, in October of this year, announced a long-term agreement with the community with respect to surface rights on the project. Having community support is a very strong indication of the local support for our project as we move through the permitting process. As I mentioned, we did go through a management change in May. The new team is led by Greg Smith, the former CFO of Mine Finders and a chartered accountant by background. Lawrence Morris comes on as the COO, the acting COO of Mine Finders. He brings with him a strong team of operators through cost engineers, construction engineers that were all at Mine Finders, and were really credited with turning the Dolores operation around, resulting in a $1.5 billion sale to Pan American. Bill Pincus, the former CEO, he remains on as chairman of the company. The project itself is located in the Mexican state of Morelos, approximately 200 kilometers south of Mexico City and 30 kilometers south of the city of Cuernavaca. There's excellent infrastructure, and the project has easy access. The area itself is very safe and secure, and we have community support. As I mentioned, we updated our resource in September 2012. The old resource is shown on the left, and our new resource on the right, highlighted by a 60% increase in M&I and a 10% increase in grade. The resource from 2010 supported a 6-year mine life, and with the substantial increase, we expect a longer mine life, and we'll be using this new resource to go into a bankable feasibility study for Q1 of 2013. The operation itself is expected to be an open pit heap leach operation, very simple and conventional. The PEA highlighted production of over 100,000 ounces per year at modest operating costs of $500 per ounce. Capital on the project was outlined at $115 million. However, we see substantial opportunity to restructure that capital. Most notably, the PEA was based on owner-owned fleet. The two pieces in blue in the bottom left represent the truck fleet and support equipment of $45 million. Esperanza intends to go into production on a contract mine basis, which will completely eliminate that $45 million of capital. There will be a corresponding increase in ongoing operating costs, but the project has low operating costs and is able to support it, and going into production on a contract mine basis gives the company more flexibility and substantially reduces the capital required to build the project. Other items for flexibility include the crusher and the heap leach phase 2 highlighted in orange on the chart. We intend to go into production on a run-of-mine basis and build a crusher out of cash flow, and we are able to stage our heap leach pads over the course of the mine life so that we don't need to build them all up front. What this leaves us with is $65 million in capital from the PEA, and we're refining that number now into a bankable feasibility study in Q1 of 2013. One of the things that we like about the project is that there's not a lot of infrastructure, so it doesn't lend itself well to inflation. It's very simple and straightforward, just a couple of leach pads and some small amount of a Merrill-Crowe plant and some buildings. It's pretty straightforward in terms of a build. We're well funded already with $40 million in cash on hand, but we will be looking to secure the rest of the financing in 2013. Our number one option is project debt. We've had several banks on site, and a number of them have expressed interest. So we will be pursuing this, and the interest they've given us has been pretty reasonable with no requirements for hedging. We'll be pursuing this in the first half of 2013. The other option that we have is the mine produces some byproduct silver. There have been several notable silver streams lately, including Hudbay's $750 million deal with Silver Wheaton and Inmet's $1 billion deal on Cobre Panama. We will be evaluating ways in which we could monetize our silver, but debt remains our first option. Having $40 million in cash on the balance sheet really gives us a lot of flexibility in pursuing financing options. This is a Google Earth snapshot of the project. The expected open pit is highlighted in orange on the picture. One thing I'd really like to point out is the southwest extension that's not currently in the resource or the mine plan. The deposit remains open in several directions, but the southwest extension is really the low-hanging fruit with respect to exploration potential. We've proven mineralization there, and next year we intend to do a 5,000-meter drill program to test that extension. As you can see on the bottom right, there are power lines going through the area, so we have excellent access to infrastructure. The project itself, in terms of moving forward, we recently announced a service land agreement, which was a big step for the company securing local community support. We'll use this surface rights agreement as part of our broader permit application that we'll be submitting by the end of this month. Once we're in permitting, we'll be working on our bankable feasibility study that we expect to release by the end of Q1 2013. The permitting process is fairly well defined in Mexico, and it should put us in Q3 of next year with our expectation to hopefully obtain all our permits. Once we obtain those permits, it's a 9-month construction period, which will have us expected to begin production sometime in 2014. There are a lot of reasons to like the project. It's very low risk, manageable capital requirements. It's a straightforward open pit heap leach operation, very strong economics. We have a silver byproduct credit, excellent infrastructure. We've got the team in place now, very strong engineering background with the mine finders operators to really deliver the project. Our other assets are headlined by our interest in Global Minerals. It's a 26% interest in Global that currently has an equity value of $11 million. Global Minerals is progressing the underground mine rehabilitation project Strborna in Slovakia. They're well funded with over $10 million in cash. Bill Pincus, our chairman, is the CEO of Global and has a long history of excellent exploration success. They're drilling that project now, and we're excited to see those results. We also have a 1% NSR on the San Luis silver project in Peru that Silver Standard is advancing. Silver Standard has spent over $10 million exploring that project in the past 2 years and are continuing to be aggressive in furthering that project. There's a lot of value to surface at Cerro Humil. Shown on this chart is the results from the preliminary economic assessment from 2011, with the NPV and IRR shown at various gold prices. At $1,250 gold, the project had an NPV of $165 million, and at current gold prices, it exceeds $300 million. The interesting thing to note on this chart is this is based off the old resource. We just added over 500,000 ounces of resources in September 2012 that is not reflected in these NPVs. So we expect to see some improvement in these economics as we continue to advance the engineering. This is another way to look at the after-tax NPV relative to our enterprise value, which is shown at the very bottom of the chart of $60 million. Again, these NPVs are after-tax, discounted, and do not include the new resource of over 1.5 million ounces. So once the additional ounces are incorporated into the mine plan, we expect to see some upside here, and we think we've got a lot of runway to work with in terms of adding value. Shown here is a number of open pit heap leach mines and projects in Mexico. San Antonio, La Colorado, El Castillo, together they make up Argonaut prior to the acquisition of Prodigy, and they carry a strong market value of over $900 million. San Francisco, shown in blue, is Timmins, that has a market cap north of $350 million. La India was formerly Grade Resources, which Agnico acquired for $270 million a couple years ago. The one thing we see Cerro Humil, it compares incredibly favorably with respect to both grade and ounces. So the market likes these types of projects because they have very low capital. Once the mine is in operation, there's not a lot of ongoing capital. Sustaining capital is very low. There's no mine development or underground workings that need to be done. So these projects are very attractive, and Cerro Humil ranks as one of the better ones, particularly with respect to grade and ounces in Mexico. To conclude, really it's a very simple and straightforward story. We've got a great asset, we've got a great balance sheet, we've got a great team to deliver it, and we're moving forward and just fast-tracking the project towards production. And once we hit there, we think there'll be a substantial value re-rate once we begin producing cash. So we're just on that track now, fast-tracking it towards production and cash flow. Thank you. Are there any questions? All right, our booth is just around the corner, so if there are any further questions, people can follow up with me there. Thank you.